Okay, so why do we care about cash flows? Well, we want positive cash flow because it allows us to pay dividends to our owners, right? Us, the shareholders of ePhone. We can expand our operations. It lets us buy more plant and equipment. It might let us pay more people. We can open another retail store. We can hire more engineers to design software, right? Replace assets if we need them, and take advantage of market opportunities. So financial analysts are people who will cover many companies. They'll look at the stocks and they'll tell you if it's a good purchase or a bad purchase. And one of the things they'll use is the cash flow of the business, how much cash the business is generating every year. Okay, and it's an indicator of financial health. The same if you go to your doctor and he tests your blood pressure and blood sugar and takes your weight and all that. That's the equivalent of looking at the statement of cash flows. It looks at a company's financial health. Okay, so what's classified as cash on the balance sheet? Well, it's the hard currency, what you would think of as cash. If you have 20 bucks in your pocket, that's cash. But there's also something called cash equivalents. So these are short-term and highly liquid, and they're so close to being cash that we call them cash. So oftentimes companies will, so you'll see so near to maturity that market value is unaffected by interest rate changes. A maturity of less than 3 months. You know what, I forgot the cable for my tablet, but we'll try this. Original maturities of less than 3 months. So companies will often not just want cash sitting in their bank account. You can invest for very short periods of time and earn very small rates of interest. So companies will usually do that. But for all intents and purposes, that's equivalent to cash, right? It's just you could cash it out tomorrow and pay off bills. So, all right, so this should be nothing new. We classify the statement of cash flows into 3 segments. The first is operating. Cash inflows and outflows directly related to earnings from normal operations. So this would be your revenues and expenses, okay? Investing activities, cash inflows and outflows related to the acquisition, to buy, or sale of long-term assets. Okay, so that would be, remember the example that we discussed where if you sell a piece of land that your warehouse was on and we realize a gain, we're not in the business. Our day-to-day normal operations are not selling the warehouse or the land for a gain, but we might happen to realize a gain. That would be an investing activity, okay, because we're disposing or selling a long-term asset. Okay, conversely, buying a long-term asset, if we buy a piece of machinery, yes, we will be using that machinery to generate operating income in our normal operations, but the purchase of that machinery is considered an investing activity. Okay? And then we have financing activities. Cash inflows and outflows related to external sources of financing. So anytime we see money coming in the corporation or leaving the corporation, related to shareholders or creditors, that's the section it shows up in. Okay, so you can broadly think of the business as having almost these 3 segments: operating, investing, and financing. So this just shows the same thing a little bit more graphically, but we have inflows, right? Where could we possibly get money from? These are really the only sources. Cash received from revenue, right? We sell phones. Sale of operational assets. And again, that's if we sell, for example, a piece of old equipment, that's going to generate cash, right? If you have an old car and you need money to buy a new computer, you can sell your old car. And the third is issuance of shares or bonds or notes or bank debt. Okay, and there's actually a whole chapter on bonds, so don't worry about that, but this is all broadly classified as debt. I really apologize for the handwriting here. So those are all the inflows to the business, and then we have the outflows. That would be cash you pay for expenses, purchase of operational assets, okay, if we're buying manufacturing equipment, or if we're paying dividends to our shareholders, or we're buying back shares, or we're paying back debt. Okay, so here's an example, and we're going to go through all these numbers in detail. But one thing you should note is ePhone is using what is called the indirect method, okay? There's two methods of preparing a statement of cash flows. Now, in theory, it won't matter. You'll get to the exact same ending cash balance. Your beginning cash balance, if you see this here, cash and cash equivalents, beginning of period and end of period, these are actual numbers that you can see in your bank statement, right? This would be what was your bank balance on January 1st and what was your bank balance on December 31st. Okay, there's no way around that. Those are actual factual numbers, okay? So the method that we use to get to it should get us to the same place, right? You're just taking a different route to get there. So there's two methods, and we'll go over how you calculate them, but 99.5% of companies use this method, the indirect method. It's because it's easier to do. It's harder to implement the direct method, so you don't need to know the direct method. We'll focus on the indirect method. But the important thing to note is this balance here, cash and cash equivalents, end of period, that will show up on your statement of financial position. And this beginning balance will be last year's cash balance from the statement of financial position. Okay, those are factual numbers. Let me see if we go. Okay, so here you can see the three segments, right? You can see one, the operating activities. Two, the investing activities. And three, the financing activities. Okay, you can see that segmentation. So this just goes over, this is kind of like the definition of how you get direct versus indirect method. Again, you don't really need to know the difference here. Our focus is on the indirect method. Okay. So what's important to note under the indirect method is we start with accrual profit and convert to cash basis. So there's a lot of information in that sentence. So remember how our accounting statements don't care about, the income statement and the balance sheet don't care about when cash is received, right? We care about when the expense is incurred or when revenue is earned, right? That's been the whole for the last 3 weeks, what we've looked at. How do you book an entry to recognize an expense and a payable, or to recognize a revenue and an asset, right? Regardless of when cash is received. So that means that your net income, your net profit on the statement of earnings is called accrual. It's called accrual profit, okay? What we want to convert to is cash profit, okay? So what we're saying is unless we received cash for providing a product or service, we're not going to count it as revenue. And conversely, if we don't pay for an expense, we're not going to count it as an expense. Okay, so it leads to a different way of looking at the company, but it starts with net income, and we're going to make some adjustments. We're going to make adjustments that accounting mandates be made to get to accrual profit and then reverse them, basically. So note that no matter which format is used, the same amount of net cash flows from operating activities is generated. Okay, now net cash flows from operating activities, you can see here, is 10 million. Okay, and we'll get into the calculation soon, but regardless of how you do it, you'll get to 10 million. There's no way around it. Same way your balance sheet always has to balance. You can't really prepare a balance sheet or a statement of financial position that doesn't balance. So IFRS, remember International Financial Reporting Standards, encourage companies to use the direct method, but it's rarely seen in practice. Okay, so what are some examples of cash inflows and outflows from operating activities? So we can generate revenue from customers, that's pretty obvious. But if we have investments or cash sitting in a bank account that generate dividend and interest, that also counts as revenue under operating activities. Expenses would be purchases of inventory. That's goods for resale or services. So if we're a retailer, if we're Walmart and we need to buy ePhones to sell them, of course your ePhones are an operating expense, right, when you sell them. Salaries and wages, income taxes, and interest on liabilities. Okay, so this is important to note, right? Notice how the interest on liabilities is contained as an operating activity, but the repayment of debt, the repayment of the principal is considered a financing activity. Okay? What are some examples of cash flows from investing activities? That's the second section. So we can receive money from selling or disposing of property, plant, and equipment. And if we have long-term investments, initially when we made the investment, we would have classified it as an investing activity because we're not in the business of making long-term investments. And then when we sell that long-term investment, it'll be an inflow and it'll be counted as an investing inflow. Conversely, outflows would be if we purchase property, plant, and equipment, right? We go out and we buy a piece of machinery, you go out and you buy a car, or you invest your money in Google stock. Financing activities are money we receive. Remember how in the first class we said, how is ePhone gonna get money, right? How are we gonna capitalize our business? How are we gonna be able to, in the first place, buy a piece of machinery and pay our employees? Well, we can go to the bank, creditors, to give us money, or we can issue shares to shareholders. Okay, we saw this in the very first class. These are classified as financing activities. And then the outflow is just cash related to those parties, shareholders and creditors. Repaying principal, excluding interest if it's classified as an operating activity, right? Excluding interest. Repurchasing shares. So ePhone can actually say, instead of paying a dividend, ePhone can actually say, I'll buy your share off of you. The same way you might want to sell your share to someone in the Econ 101 class, you could sell your share back to ePhone and they'll pay you the same price for it. You still get cash, right? You're indifferent. It's just how ePhone wants to manage its capital structure. And then there's dividends to shareholders, right? We've seen dividends before. Okay, so conceptually, why have we waited until now to show the statement of cash flows? It's very important. It's an important statement, but we went through the statement of financial position and the statement of income first. The reason is you need those two statements to be able to build the statement of cash flows. Every transaction you've recorded so far in a journal entry has affected directly either the statement of income or the statement of financial position. You don't actually directly affect the statement of cash flows. Okay, the statement of cash flows is derived from the balance sheet and the income statement. So that's why you build those up first. That's why we taught them first. Okay, so what do you need? What information is needed to prepare a statement of cash flows? Well, you need statements of financial position, as I just said, but they need to be comparative. Comparative means you need to show last year's balance and this year's balance, and you'll see why. You can't just have the current year balance. You need balance as of December 31, 2016 and balance as of December 31, 2015. You need the statement of earnings. Those are the two main ones, and then you sort of need additional details concerning selected accounts, transactions, and event. But with 1 and 2, with comparative statement of financial position and statement of earnings, you have everything you need to prepare a statement of cash flows. So all we're actually doing is pulling numbers from the statement of financial position and the statement of income and rearranging them to put them into a statement of cash flows. And it works a little bit like magic the first time you see it, because you won't believe that it's going to get to the right number because it just goes off in all different directions. But you'll see that it always works. Okay, so this is a great slide if you're more of a logic or math-based person. So we have the accounting equation, right? Assets equals liabilities plus shareholders' equity. That's nothing new. So we can rearrange this equation. We can do a couple things. First of all, okay, so this sign, this is called delta, and that just means change or difference. Okay, so we can put the delta sign on both sides. That means that if our assets have to equal our liabilities plus shareholders' equity, the change in our assets has to equal the change in our liabilities plus the change in shareholders' equity, right? Assets can be broadly divided into two categories. One is cash, and the other is everything but cash, non-cash. That includes accounts receivable, prepaid expenses, property, plant, and equipment. Okay. And then all we do is solve for cash. Okay, we leave cash on the left-hand side, we leave liabilities, we leave shareholders' equity, and we move this non-cash, because it's positive, over to the other side and put a negative sign over it. And now we have that the change in cash is going to be equivalent to your change in liabilities plus your change in shareholders' equity minus your change in non-cash assets. Okay, so it's just a different way to think about it if you want to try to solve for it this way. Okay, so let's look at, this is almost a summary of typical journal entries. Okay, so you should be familiar with the nature of all these journal entries. All we've done here is categorize the transaction into either operating, investing, or financing, and showing what the impact on cash is. Remember, cash is an asset account, therefore it has a debit balance. Therefore, if you see plus cash, that means we're debiting cash. If you see minus cash, that means we're crediting cash. So let's go through a couple of these as examples. Collect trade receivables. Collect accounts receivable. So what are accounts receivable again? We make a sale, okay, credit revenue, debit accounts receivable, and then we collect that account receivable at some point in the future. Credit account receivable, debit cash, right? So the transaction of collecting a trade receivable just shows we're increasing cash and we're decreasing trade receivable. Okay, this is really just a way to think about all your journal entries that you already know and just really focus on, is cash increasing or decreasing as a result of each of these transactions. There's really no new information here. It's just putting it into a different perspective, okay? Let's look at another example. Prepay rent. What's the journal entry if you prepay rent? If you prepaid your landlord for a year, do you have a question? Oh. Yeah. If you prepaid rent for a year on January 1st, what would your personal journal entry be? You'd credit cash because your cash balance is declining, and you debit prepaid rent, right? And then every month you would expense 1 month's worth of rent. Debit rent expense, credit prepaid rent. So in that case, your cash is going down, credit cash, increase prepaid rent. Okay, investing, purchase equipment for cash. Again, this is probably one of the first journal entries we looked at. We bought a piece of machinery. We pay in cash, nice and simple. Financing, pay back debt to the bank. Our note payable balance is going down or our bank debt balance is going down, but the amount of cash we have is also going down, right? So the focus here is thinking about how cash moves with each of these transactions. Okay, so the indirect method adjusts profits by eliminating non-cash items. Okay, what does that mean? So we start with net earnings. Remember, that's why you need your statement of comprehensive income, because you need to know what the net earnings are. And then you make adjustments. We make adjustments for losses and gains, and we'll go over this in detail. Changes for current assets and current liabilities, as well as non-cash expenses such as depreciation. Remember when we book our depreciation entry, right? So let's say we buy that truck at the beginning of the year on January 1st, and we're going to use it to make deliveries. And let's say we buy it for $10,000. So we credit cash $10,000, and we debit truck for $10,000. And then at the end of the year, we depreciate it, right? So what's our depreciation entry? Let's say it's a 5-year life. It's going to be debit depreciation expense $2,000, credit accumulated depreciation $2,000. That transaction did not impact cash. That's called a non-cash transaction. We paid the cash on January 1st, and that's actually an investing activity because we bought the truck. But depreciation is non-cash. It's solely an accounting item. Okay? A lot of non-accountants really don't like depreciation because they think it's not real, just because cash hasn't left your hands, right? But cash did leave your hands just earlier in the year, or in an earlier year even, right? 3 years on, we're still going to be recognizing a depreciation expense of $2,000 every year, but the cash left our bank 3 years ago. Okay, so depreciation is called a non-cash expense. Amortization is the same thing as depreciation. It's just depending on the type of asset, you call it depreciation versus amortization, but it's the same thing. And once we make all these adjustments, we get to cash flows from operating activities. Okay, and remember, that's just the first section. Okay, so this is a little bit complicated. We're going to show this in detail, but the question is, how do you make, okay, so going back here, we say, well, you have to make changes in current assets and current liabilities, plus or minus changes in current assets or current liabilities to adjust your net earnings to cash flow from operations. So this chart actually guides you on how to know if you have to increase net income or decrease net income to get to cash from operations. Okay. So on the left-hand side, we have current assets and current liabilities. Remember, current means they're going to be disposed of within a year, or used within a year, or paid within a year. Okay, and these are often operating in nature. Inventory is a current asset because you hope to sell it within the next year. An account payable is a current liability because you should be paying it within 6 months. Okay, so when you look at, we'll start with a current asset. Looking at a current asset, we look, has it increased from the previous year or decreased from the previous year? Notice how these are both balance sheet accounts. I really apologize. So these are both balance sheet accounts. That's why we need the comparative balance sheet to see if relative to last year the balance has increased or decreased. Did our accounts pay, if our accounts receivable balance, the current asset, at December 31st, 2015 was $100, and of course we're going to book 100 transactions going in and out of there throughout the year, but then at December 31st, 2016, we look and we see the balance is 200. So on a net basis, the accounts receivable has increased, right? So just trust me that this is true for now. That means we have to subtract that amount from net earnings, okay? And I'll show you why that works. But this table is good for reference when you're learning because it'll help get your mind straight about which direction the adjustment needs to go. Okay, because if you're making a positive adjustment to net earnings, if you're saying add to net earnings when you should be subtracting from net earnings, or vice versa, you're never going to get to the right cash number, right? The other thing to notice about this table is similar to the debits and credits problem, whereby you have all these different cases in theory, but as long as you know one, you know the rest because they're mutually exclusive. Right? So you know that if an increase in current assets means a subtraction in net earnings, you therefore know that, well, a decrease in current assets means an add to net earnings, and you know that assets and liabilities have reversed signs. Okay, so you therefore know that, well, if an increase in current assets means a decrease in net earnings, that means that an increase in current liabilities means an increase in earnings, and then vice versa for a decrease in current liabilities. Okay, so once you know one, you can actually solve for the rest. I'm going to go into a lot more detail. We're going to spend a significant portion of time going over how to calculate these numbers, okay? Okay, so working capital is the same as current assets and net of current liabilities. That's called your working capital. Okay, so when building up the statement of cash flows, for every account on the balance sheet, you have to think of two things. One, is it an asset or liability? Meaning, are you number one or number two here? And two, did the balance increase or decrease from the previous period? So are you in case A or case B? Okay, there's only 4 possible cases. You can be 1A, 1B, 2A, 2B. So for every account, go through this, you have to iterate this process, right? You have to say, all right, is this an asset or liability? Did it increase or decrease? Which case am I in? 1A, 1B, 2A, 2B? And then that'll tell you whether you subtract or add to net earnings. Now this approach that I'm describing is a memorization approach, which I don't like. And I'm going to explain how to get to a way to think about it properly so you understand why this is the case, and then you won't need to memorize it. Okay, so here's an example of a consolidated statement of financial position. Notice how it's comparative because we show 2 years. And in fact, almost any balance sheet you look at will show 2 years, okay? Because people want to know how the balance has changed year over year. So let's just compare the balances. Let's not start making any adjustments yet. Let's just look at what's changed year over year. Here's our current year. I mean, we're in 2015 here, but that's fine. I guess the slide's a little bit old. But you can see our cash balance has increased by 48.55, right? 33,553 less 28,698, right? So our cash balance has increased by 48.55 on a net basis. There's a lot that could have happened throughout the year. At one point, our cash balance could have been 100,000 or it could have been 0. We fluctuated throughout the year, right? But all we're saying is on July 1st, 2014, we were at 28,698 in the bank. And now June 30th, 2015, we're at 33,553 in the bank, okay? And so that same logic applies to all of these balances, right? Trade receivables, accounts receivable has increased. Inventory has decreased. Prepayments have decreased. And we go all the way down the list for all the accounts, okay? So this is step 1. You need to know what the differences are in each of the accounts. We haven't really done anything new here. You all know what the balance sheet looks like. All we've done is contrast year over year. And our statement of earnings. So again, you guys all know how to build this up. And we remember how our cash flow from operations starts with net earnings. Okay, so again, we haven't really done anything novel here. So now we're going to build up the statement of cash flows. So what I want you to note is net earnings per our statement of earnings, 4028, is the starting point for the statement of cash flows, 4028. Okay? The first step is to adjust net earnings for depreciation and amortization expense and other items not affecting cash. Notice here how they have depreciation of property, plant, and equipment, 3366. So that would have been, we would have booked an entry for debit depreciation expense 3366, credit accumulated depreciation 3366. Why are we adding it? Because net earnings of 4028 has been reduced by this depreciation, right? This is an expense. In fact, our net earnings is going to increase, in theory, if we didn't have this depreciation expense. Okay. Remember how I said depreciation and amortization are the same thing, it just depends on the type of asset. So depreciation applies to tangible or physical assets. Amortization applies to intangible assets. Software is considered an intangible asset. So the word is amortization, but it's the exact same concept. If you buy a piece of software that's expected to last for 3 years, you'll depreciate 1/3 of the software every year, or you'll amortize 1/3 of the software every year. Now, if you're wondering where these numbers are coming from, we'll just look back here. We have depreciation and amortization, and these are non-cash expenses. So we're trying to say, okay, if we didn't book these expenses, let's assume every other transaction occurred in cash. Okay, let's say this net sales means we actually received $148,000, or millions because we're in thousand, $148 million in cash from our customers. And we paid $71 million for inventory. And for selling general and admin expenses, we paid 67 million. Okay, let's assume everything else occurred in cash except for depreciation and amortization. So we want to see how net income would look if we only accounted for the cash transactions. Okay, so we have to add back the expense of depreciation and amortization. Okay, so you would, and so do not worry about deferred income tax. I don't believe you need to, I'm certain you don't need to know that. Okay, so don't worry about that. They're just showing that number here and I don't know why, but so you can see that once we adjust net earnings for these non-cash expenses, it increases. $7,107. So that's saying that our net earnings, before we booked these accounting expenses, we would have earned $7,000 in cash, right? But the accounting expenses are kind of creating a bit of noise in the earnings. So that's step one. So to approach this step, you'll need to look at the income statement and scan it and look for the keyword depreciation. And you'll see a number to the right here, and then you'll pull that as an addition, okay? Okay, so this is a tough one. Step two. So now we have to adjust net earnings for changes in non-cash operating working capital items. So remember how I said, imagine all of these other transactions happened in cash. Imagine we received $148 million in cash from our supplier, from our customers, and we paid $71 million to our suppliers for inventory. But we know that that doesn't happen, right? Because we use the accrual basis of accounting, we might have only recognized, or rather received, 100 grand in cash for these sales, and we might have accounts receivable of 48,000 or 48 million, right? So from one perspective, once we've shipped the good and recognized, then we get to recognize the revenue, right? Credit revenue, debit account receivable, 48 million. From a cash flow perspective, that's not cash earnings, right? We only care about how much cash we received. So the first adjustment is looking at the increase in trade receivables. So let's go back to so we see that trade receivables increased by 130. So we see that trade receivables increased by 132, right? So I want you to think very simple. Let's say there were only 2 transactions in the entire year for this company. Let's just focus in on trade receivables, okay? Let's say the first transaction was the customer who owed us the $385 last year paid us. So what's the entry there? Debit cash, credit AR, 385. Okay, so cash increases, net 385. The second transaction in the year was we made a sale to a customer for 517. What's the entry there? Debit AR, credit revenue. Okay, so that actually summarizes all the transactions that occurred in the year and kind of condenses it, right? From an accounts receivable perspective. So if we received $385 in cash, okay, and that's coming from last year's, a sale made last year, we're not going to be recording that in income this year, right? We recorded it in income in 2014. In 2015, how much income are we recording? 517 of revenue. How much of that was received in cash? Well, we didn't receive any of it in cash because it's all still outstanding as an account receivable. So you can almost think of removing any account receivable balance we have currently on the balance sheet Because by definition, if we have an account receivable, we haven't yet received the cash, but we would have booked the revenue. So you can think of, let's remove the impact of that sale transaction. Let's reverse it. Let's imagine that sale didn't happen because we didn't get the cash yet. Okay, so revenue comes down by 517. But we are going to say, hey, but we received $385 of cash from a sale we made 2 years ago or last year, but our customer finally paid us. So we're going to count that as revenue this year if we were using a cash basis of accounting. What's the net impact? We're increasing cash by 385 and then we're decreasing cash by 517. The net impact is a net decrease in cash by 132. And that is why you see the increase in trade receivable is a subtraction. We're effectively saying that buried in this net earnings of 4028 is $132 of revenue for which we haven't yet collected cash. Now, if you want to check the work, let's go to our chart, right? If you want to do this sort of the memorization way, so first step, are we talking about an asset or a liability? It's an asset. Okay, so we're in case 1. And did the amount increase or decrease? It increased, so we're in case A. So we have to subtract the number from net earnings. Okay, now here's something that's very confusing. You can have an increase in trade receivables, which you think of as a positive number, and it shows up as a negative here. You have a decrease in inventory. Notice how if we go back to the comparative balance sheet, your inventory is decreasing by 4073. And yet, on our statement of financial position, or on our statement of cash flows, it's a positive. Okay? So, you have to be very conscientious when you're doing this. Okay? On the midterm, you have to write increase and decrease, or increase or decrease. I'd say more than half the class just wrote trade receivables and then put a number. You have to show that you know that trade receivables is increasing, resulting in a decrease in net earnings, okay? The exact same logic applies to every one of these accounts, okay? Decrease in trade payables, so that was an asset. Let's look at a liability. Decrease in trade payables. Okay, so trade payables are going down and we see it's coming out of cash. So why is that? So let's go back to trying to reconcile. We'll focus in on that balance and I'll show you the logic. So last year, June 30th, 2014, we owed a supplier $9,210. Okay. And this year we owe our suppliers $8,137. So there's a few ways to think about it. One is, let's say we didn't take on any new credit from our suppliers, and all we did was pay down some of the balance we owed. That's the simplest way of looking at it, right? We did owe them $9,210. Now we only owe them $8,137. The only way to get that transaction to occur is debit account payable, credit cash, decrease in cash. Okay. You can think of it as we fully paid off last year's trade payable. Okay, credit 9210, or credit cash for 9210, debit AP for 9210. Start with a zero balance. And then let's assume that those trade payables arose from expenses. So let's say we accrued a bunch of expenses at the end of the year. Utilities, salaries, right? Maybe is interest expense broken out separately? It's not broken out separately. But you can think of it as, well, usually they're in the same category, accrued liabilities and trade payables. But you can think of us as accruing all these expenses, okay, for which we haven't yet paid cash. So if we're accruing expenses, what's the entry? Debit utilities expense, credit payable. We haven't yet paid the cash, so there's no cash impact. So From that transaction alone, you would think, well, we should, similar to depreciation, it's a non-cash expense. We should add it back, right? We're taking away from our profit, but we haven't really paid any cash, which is true. Okay, you've incurred $8,137,000 worth of expenses on the income statement that you haven't paid in cash, so you should add that back. But then you have to account for the fact that you paid your suppliers $92.10 in the year. The net impact is you're out of pocket by $1,073. Okay, the simplest way to look at it is we're effectively debiting trade payables by $1073, so the credit has to go to cash. You can think of booking a journal entry for each of these changes, okay, whereby you're trying to get this end balance. So if I want trade receivables to increase from 385 to 517, I need to book an entry to debit the trade receivable for 132 and book the other side of the entry to cash. And you'll say, okay, well, cash is a credit, right? Debit, AR, credit, cash. And that will work for every transaction. Okay, but let's go back to the example here and I'll show you. So decrease in trade payable. So what case are we in? Current liabilities, case 2, decreased. B, subtract from net earnings. And that's why you'll see that number as a negative here. Okay, it doesn't matter which working capital account it is. This will always work, okay, but on the midterm, please put increase or decrease, okay, and also some people would just put increase and then put a number, they wouldn't say what account. So put increase or decrease, put the working capital account number, and you have to get your sign right. Now okay, so on the midterm, the way we mark is we use carry forward logic, meaning if you mistakenly put plus 132 instead of minus 132, in theory, the rest of your answer is wrong, right? None of your other balances are going to flow through, but you don't get penalized for that. Okay, how it works is you won't get the mark for this line, but as long as your total cash agrees to everything else, as long as you flowed through the logic correctly, you'll still get the marks for all the other parts, okay? So it's important you get the sign right, but it's not going to be disastrous if you don't. Okay, and I don't design questions that are continuous because then your errors just carry forward and everybody has errors. So it becomes impossible to mark and it's just not fun for anybody. So the focus, if your logic is correct, then you'll still get marks, but really focus on increase or decrease. You have to state the account name and you have to show the plus or minus, okay, when you're doing this, okay? So this part of the slide will just walk you through what segment we're in for each of these accounts. So I recommend you look at this on your own when you're doing the problems. If you can't get the directions right, okay, it might help to identify each of these accounts as an asset or a liability for yourself, okay? So this is how we get to the line item net cash provided by operating activities. Notice how we've gone from $4 million of net earnings to $10 million of cash provided by operating activities. Why do we have used in brackets? Because sometimes this will actually be a negative. And if it's a negative, we'll actually say net cash used in operating activities. Okay? But this goes to show the difference between accrual accounting and cash basis accounting, right? The company is generating a lot of cash from its operations. It's generating $10 million a year from its cash operations, even though its net income is only showing as $4 million. So this is the way I like to think about it, which is what I just described. Use journal entries in the accounting equation. What journal entry would have to have occurred to result in the increase or decrease in the working capital item, assuming that cash is going to be the other account. Cash is going to be your balancing account. And remember, since cash is an asset, a debit increases the balance and a credit decreases the balance. Okay, so please practice this. I'd say the vast majority of people got it wrong in the midterm. I know it's complicated, but it's, once you get it, you'll have a very thorough understanding of the accounting equation. It'll be hard to fool you after that. So here's just an example of kind of the thought process. So let's look back at that increase in trade receivables. So the thought process would be, well, if my trade receivables increase by 132, that's a debit. I need a credit, it has to be cash. So I'm crediting cash, and therefore you see minus 132. Remember, the goal of this is to get to impacts in cash, right? We're showing the cash balance. Same thing, just for the accrued liabilities. If my accrued liabilities are increasing by 316, I know that's a credit. So you know your debit has to go to cash. That's an increase to cash. Why don't we take 10 minutes, and then we'll be back for 7:30, okay?